How long can we wait for a recession? Macroeconomic indicators show that the recession that everyone is tired of waiting for will not come. The third estimate of GDP showed that the U.S. economy grew by 2% in the first quarter. The number of unemployment claims fell to its lowest level since May. Banks passed the stress test successfully. Consumer sentiment and new home sales improved to the highest level since the beginning of last year. Everything looks great and does not justify the pessimistic forecasts that were published in the winter. Hi, this is a quick review from Ivan Kompan, Edinburgh Business School analyst.
The economy is growing in spite of everything. Moreover, the economic growth and labor market recovery are taking place in the context of the fastest growth in interest rates in the United States in decades, which rose from 0 to 5 over the year. And growth continues even in those segments of the economy that are traditionally very sensitive to the high cost of money.
Today, the main driving force behind economic growth is the increase in consumer expenditure. Americans are ready to buy everything from cars to a wide variety of services. Consumer confidence in the future is growing, strengthening their willingness to spend more and more.
The labor market only adds to consumers' confidence by continually creating new jobs. Interestingly, none of the economists are able to explain the reasons for this situation. Among the main possible reasons are the increase in life expectancy, late retirement, and the desire to pay more attention to the family by reducing working hours, as well as a decrease in emigration.
So, it looks great, but is everything so good? Fed Chairman Powell noted that the economy is growing faster than expected, but inflation is also higher than expected. It is the rising prices that spoil the whole picture and force central banks to raise interest rates in the hope of slowing down the economy and bringing inflation down to the acceptable 2% target. So, it seems that the story of rate hikes is far from over.
What about the inversion of the yield curve, an indicator that has always accurately predicted economic downturns? By the way, the difference in yields between 2- and 10-year bonds is currently the widest in 42 years, and no one knows exactly how long it will take for a reversal to begin. During the dot-com crisis, it took 16 months from the beginning of the inversion to the beginning of the crisis, and in 2008, almost 20 months. This time, the inversion has been going on for a year, so we'll probably have to wait.
And what about the markets? On the one hand, the stock market can't miss out on growth, and on the other hand, you don't want to be left with a portfolio of overvalued stocks, but you don't want to be without profits either. That's how greed fights fear, and so far it's winning, but how long will it last?
And finally, we would like to remind you that the information you have just listened to is not an investment advisory. Remember, investments in the stock market are always tied up with financial risks. So be careful and cautious. Like and subscribe to our YouTube channel. See you soon!